You've probably seen the term EBITDA floating around in financial reports or investor meetings. And maybe you've even heard people say, our EBITDA is up this quarter. Woo! But what does it actually mean? And why should you care? Well, EBITDA is a key measure of business profitability, but unlike net profit, it strips away certain costs to give a clearer view of how well your business is actually performing. So, what does EBITDA stand for? EBITDA, earnings before interest, taxes, depreciation, and amortization. In simple terms, it tells you how profitable your core business is before the financial structure and tax strategy come into play. So, why should this matter to business owners? Well, first, it helps measure true business profitability. If your EBITDA is strong, your business is generating solid earnings from its core operations. And it's also a key factor for lenders and investors. If you're looking to be able to get a loan or potentially put yourself out on the market, banks and investors often compare businesses using EBITDA because it does remove those nuances of financial and tax differences. It also tracks business growth over time. So if you compare EBITDA year over year, you're able to compare profitability without the fluctuations that taxes or interest might encounter year on year as those payments change. So let's go through an example. Here's the mathematical formula for EBITDA. You take your net profit and then you literally add back interest, taxes, depreciation, and amortization to get your earnings before interest, taxes, depreciation, and amortization. Let's say that a company's net profit is $50,000. If you paid $10,000 in interest, $5,000 in taxes, and had $8,000 total in depreciation and amortization, then your EBITDA would be 50,000 plus 10,000 plus 5,000 plus 8,000 for a total of $73,000. And that means before considering the financing and tax decisions that had affected your profits, your business generated $73,000 in operational earnings. So I do want to go over a couple of misconceptions and limitations. What EBITDA isn't, it isn't the same as cash flow. Just because your EBITDA is strong doesn't mean that you necessarily have cash in the bank. It also ignores debt and taxes, explicitly part of its definition. So if your business carries a lot of debt, a strong EBITDA might not paint the whole picture if your interest payments are high. And it is more useful in some industries than others. So if your business doesn't have major depreciation or financing costs, then EBITDA might not be as important for your financial analysis. At the end of the day, it is still a great tool for understanding your business's operational profitability. But EBITDA is just one piece of the puzzle. If you want to see what EBITDA says about your business and how to use it in financial planning, then let's chat. Together, we'll break down your numbers and help you make informed decisions for growth for the future.